Good morning, everyone, and a very warm welcome to everyone who's joined us today, not just from across the country, but I also saw yesterday in some of the registration feedback that we do have attendees from outside of South Africa. We've got attendees from the rest of Africa joining us as well. It's fantastic to see such a strong interest in the third edition of the IFRS for SME accounting standard. I think a lot of us are not necessarily here by choice because this is the reporting framework that we work with, but it is good to see such a strong interest in our webinar this morning. The release of the third edition marks a very important milestone for the accounting world in having still a simpler financial reporting framework that the small and medium-sized entities can use worldwide. If you are a preparer, if you are an auditor, a regulator, or an educator, it doesn't matter. Your participation today reflects on the vital role that these small businesses play in our economy. Our presenter today is going to be Claudia Hazelwood. She is the founder and director of FinRep Consulting. She is going to take charge of today's webinar. Claudia is a qualified CASA. She has over 10 years post-article experience, and as you will see today, she's passionate about financial reporting. She's passionate about learning and development. From my side, I also would like to apologize. The session that we had with Claudia, we had error in the start of that recording. So I will just be going up to about slide 13, and then from slide 14 onwards, you'll join the recording, or you'll see the recording presented by Claudia. So for the first couple of slides, you will be seeing me just going through her presentation, and then after slide number 13, Claudia will be taking you through the rest of the presentation. So let's get going. IFRS for SME Accounting Standard. Overview of the third edition. Please just briefly look at the disclaimer. None of the information presented today or the views expressed is going to be regarded as the views of PKF SA. Today's session is to introduce the major changes and to talk about the potential impact that the third edition will have on our financial reporting. What exactly will we be discussing? First up, a little bit of a background as to IFRS for SMEs, the actual accounting standard. When was the first standard issued? What is the purpose? And who can use the IFRS for SME accounting standard? Then we'll go through the background of where we are now, the second comprehensive review. Although we're busy with the third edition, this is the second big review that the IFRS for SME standard was subject to, and it brings us to the third edition. Number 3, we will then talk about what are those big changes. Comparing the 2015 version of the IFRS for SME standard with the 2025 version, what are the big changes that's going to impact how we need to report, how we need to classify, how we need to account for certain financial figures or financial instruments. We will also briefly discuss what supporting material is currently available, and then hopefully if there's time for any questions, we'll address that afterwards. IFRS for SMEs, the actual accounting standard, it is a single standard. So if we look at full IFRS or full IFRS, it is divided into multiple shorter or longer standards, each standard unpacking a specific element. IFRS for SMEs is a single standard that deals with all the financial statement areas. It is based on full IFRS, but it is a single compact standard that we will use for financial reporting. It is tailored specifically for smaller entities who can use the IFRS for SME standard. The IFRS for SME standard can be used for entities that do not have public accountability. So if we have a listed entity or a public company, they are not allowed to apply the IFRS for SME accounting framework. These entities that want to make use of IFRS for SMEs should also publish general purpose financial statements. What does an entity without public accountability, what does that mean? That means the entity's equity or debt instruments are not traded in a public market. So it's either a domestic or a foreign stock exchange, etc. Their financial instruments are not traded on those markets. And assets are not held in fiduciary capacity for a broad group of users. So for example, banks, insurance companies, mutual funds, etc., those entities are not allowed to apply the IFRS for SME accounting standard. The IFRS for SME accounting standard focuses on the information needs of the users, and this is oftentimes lenders. Its aim is to keep the financial reporting as simple as possible, but still to address the users of the interest of the users of the financial statements, and the interest then mainly of the lenders who make use of those financial statements, who rely on that financial statements, making sure that there will be a return on their investment. In terms of the history of where are we today and what's happened since the first edition of the IFRS for SME standard was released. The first edition was released back in 2009 and it was effective immediately. I still remember I started my articles in 2010, and my first client that I was assigned to, that was the year that the client then moved over into IFRS for SME, and I had to deal with all of that. So I have always been quite comfortable with the IFRS for SME standard since my first engagement that I was assigned to as a trainee accountant was converting an entity's figures from IFRS to IFRS for SME. 2009, we had the first edition of the simplified accounting standard. The second edition was issued in 2015. So this was the first big amendments since the 2009 version. However, that standard or the second edition was only effective in 2017. So we had a 2-year period since issue date for us to get all our ducks in a row and to apply the amendments based on the second edition. Then in 2023, there were small amendments made. The Pillar 2 model rule amendments were issued. They were also effective immediately. And that brings us to where we are now, third edition. So the third edition was issued in February 2025, and it will be effective in 2027. Okay, so we will talk about the effective date in a little bit more detail later, but we do have time to properly research and properly investigate how this transition is going to impact the financial reporting needs of our clients, and if you are a client, of your specific business and your financial reporting needs. Why are we where we are? What was the background to this second comprehensive review? The big purpose is to make sure that all the full IFRS amendments that's been taken place for the past couple of years, because our previous second edition was issued 10 years ago. And in that 10-year space, we've had quite a lot of IFRS updates that significantly changed how we applied or needed to apply certain concepts from an IFRS perspective. If we think about IFRS 9, we think about IFRS 16, IFRS 15, there's been a big development jump in the full IFRS spectrum, and the IFRS for SME standard needs to move with the full IFRS. It needs to make sure that there isn't a complete disconnect between the two accounting standards. So based on all the recent changes to the full IFRS accounting standard, it was needed that the IFRS for SME standard be aligned. So the research project into this third edition began in February 2019, and then the third edition was ultimately released in February 2025. The scope of the second comprehensive review, as I've mentioned, it was to take the requirements, the recent requirements of full IFRS issued since the first date, and make sure that there is alignment in terms of some of the major developments that's happened at the full IFRS framework. It was also needed to relook at those amendments that were not taken into account when the second update or the second edition was issued back in 2015. And then the last topic to consider was any other topics brought to the IASB's attention relating to the standard. So it was firstly to make sure all the recent amendments to the full IFRS is taken into account. Relook at the amendments that did not form part of the second edition. So are we still sure that those amendments shouldn't have taken place? And then lastly, further inputs from the ISB in terms of topics that's been part of the discussion for a couple of years. What needed to be aligned? So in terms of the framework, when we look at the background to the second comprehensive review, what is it that we need to keep in mind when we look at the IFRS for SME standard? If we look at the recent changes to full IFRS, when they think about bringing a specific requirement into IFRS for SMEs or maybe taking it out, the first question is it relevant to SMEs? If we think about IFRS 16, for example, our leases standard, is that accounting framework, are those accounting principles relevant to small, medium-sized entities? Okay. How do we determine relevance? We ask the question, is the topic relevant to our smaller entities? Then we still need to make sure that how the information is disclosed, presented, etc., is simple. Okay. There should still be an element of simplicity, otherwise we're back into the scope of full IFRS. The question that we ask ourselves there, can the requirement of full IFRS be simplified? How can we simplify the full IFRS requirements and bring that about in our SME standard? And then lastly, it's also important that faithful representation still remains. So it's relevant, it's with as much simplicity as possible, but it has to be, your presentation has to be faithful. It has to give a true reflection of the accounting entries, of the financial position of that specific reporting entity. So does the outcomes of recognition, measurement, etc., does that faithfully represent the substance of the various transactions, account balances, and disclosures? What are the standards, the full IFRS standards, that form part of this third edition or the second comprehensive review? Which of those standards impacted the major changes that's now been brought into IFRS or IFRS for SME? We are going to have a look at the conceptual framework. So the changes that's been brought about in full IFRS with regard to the conceptual framework has been brought into the IFRS for SME third edition. We're going to look at IFRS 3, business combination, some of the definitions that have now been aligned in the SME standard. IFRS 9, okay. Don't worry, we do not have ECLs. We luckily, in terms of our IFRS 9, our financial instruments, we're still going to report impairments on the incurred loss model. So we do not have ECLs, but there are some principles around how we classify our financial instruments that are aligned with full IFRS 9 or full IFRS 9. Certain elements around the control definition, as discussed in IFRS 10, has been brought into the IFRS for SME standard. We're going to look at IFRS 11, joint arrangements. IFRS 13 is the fair value measurement standard. We also now, in the third edition of the IFRS for SME standard, have a separate section that summarizes all of the fair value disclosure requirements that in IFRS is part of IFRS 13. I'm going to jump to IFRS 15, revenue from contracts with customers. Although not a full alignment, that's now been brought into the IFRS for SME standard. There are some elements in terms of the 5-step approach to revenue recognition that's now been brought into the IFRS for SME standard. The two standards that are highlighted in a grayish blue color, IFRS 15 and IFRS 16, those have not been brought into the IFRS for SME standard. IFRS 16 leases is currently being subject to an internal review. The board is assessing if it is truly achieving the objective that it wanted to achieve with that standard. And along with that comprehensive review of the standard, once that's been finalized and the decision to how that standard is going to be dealt with going forward, they will reassess the impact on IFRS for SMEs. But at this moment, IFRS 16 leases the principles and the recognition criteria, what's currently in IFRS 16, has not been brought forward to IFRS for SME. So that's the standards that were specifically scoped in or that formed part of the big updates to the IFRS for SME standard. So what are those key changes? If we look at section 2, concepts and pervasive principles, there has been specific alignment to the definition of assets and liabilities with the conceptual framework that is currently in full IFRS. Section 9, which is the consolidated and separate financial statements, the definition of control has been aligned with IFRS 10. Section 11, financial instruments. Previously, this was basic financial instruments, and section 12 was other financial instruments. But you would see on the screen the basic financial instruments and the other financial instruments have now been combined into one section, section 11, and section 12 now deals with fair value measurement. So technically, section 12 is a new section. Section 19, business combinations and goodwill. There's been small changes. And then section 23, our revenue section. Revenue from contracts with customers now applies the 5-step model that is in IFRS 15. It's not that complex or comprehensive, but it does follow the same approach. So before we deep dive into the actual changes, what remained the same? So what are some of those key areas that have not changed? So borrowing cost and development cost, there's no difference or there's no update. It is still recognized as an expense. From a goodwill perspective, goodwill is continued to be amortized. Associates and jointly controlled entities, you are still allowed to use the cost model in terms of your measurement criteria. Leases, we can continue, or the preparers can continue to either classify the lease as an operating lease or as a finance lease. So that is going to remain unchanged, or that is remaining unchanged. With regards to impairments of financial assets or debt instruments, we will continue to apply the incurred loss model. So no expected credit loss, no ECLs. We will continue to apply the same principles around impairment, which is incurred loss model. And then undue cost and effort, one of those exemptions that the IFRS for SME standard allows when it comes to measurement. That concept of undue cost and effort still remains. So it still remains for specific circumstances or subject to specific requirements for the various sections of IFRS for SME. So these key areas have remained unchanged. Our first topic, let's deep dive into concepts and pervasive principle. So this is section 2 of the IFRS for SME standard. The objective of concepts and pervasive principles, it describes the objective of SME's financial statements, and it sets out what makes up all the elements of the financial statements. What are the concepts and what are the basic principles that align the financial statements that are being prepared? As I've mentioned previously, the concepts and pervasive principles, the concept of undue cost and effort still remains. However, it is not applicable to all sections of the IFRS for SME standard. There's only specific sections that allow that relief. It is not a general principle. And when an entity does make use of the undue cost and effort exemption or relief, there is very strict disclosure requirements. You need to specifically document why was this undue cost and effort? Why does the cost and the effort, why is it not worthwhile disclosing the information in a different format? So that's, again, just being emphasized. It's still there. It's not been expanded, but please be mindful that there's strict, very strict disclosure requirements when the undue cost and effort relief is being used. And then we head over into some of the revisions specifically to the conceptual framework. So the conceptual framework in full IFRS was amended in 2018. There was new concepts relating to the measurement, presentation, disclosure, and then specifically guidance on derecognition, updated definitions of assets and liabilities, and it clarifies the concepts of prudence, stewardship, measurement uncertainty, and substance over form. So section 2 is part of the standard, of the IFRS for SME standard, and has equal authority to other sections of the standard. However, the IASB has added an overriding principle that the requirements in other sections of the standard does take precedence over section 2. So we can't say substance over form, this is relevant for the specific accounting treatment. If section 23, revenue, for example, you get to a different conclusion, we can't allow section 2 to override the principles that are currently documented in section 23. So that is important to remember. Although it is part of the standard and it should have and it has equal authority, there is an added overriding principle that was added by the IASB that the requirements in other sections takes precedence over section 2.
Briefly having a look at this in terms of some of the principles that are sitting within this asset definition that have changed and whether there really has been a change. If we look at the definition of an asset in the past, it's related to a resource that was controlled by the entity as a result of a past event. You probably know this definition off by heart, which was expected to result in an outflow. Expected to result in an economic inflow of benefits to the entity. Very important, we had the term of a resource that was controlled, and there was a probability assessed to that in terms of an expectation of an inflow. The new standard simply breaks down the concept of a resource in more detail. So the new edition refers to the definition of an asset being a present economic resource controlled by an entity as a result of past events. We note that here the term of a resource has been refined in respect of an economic resource, and even furthermore, an economic resource is referred to as a right. So in simple English, the new definition simply indicates that an asset is a present right which an entity holds, and that right purely has the potential to produce an economic benefit in comparison to the prior definition where there was an expectation. So there was a probability assessed or required in terms of the prior definition. So in terms of the recognition of an asset, it simply needs to be a right that an entity holds as a result of a past event, which needs to have the potential to produce an economic benefit. The probability in terms of how likely that is something that follows or flows through in terms of the measurement of that asset or liability. When looking at the definition of a liability, it was a present obligation which arose from a past event, which was expected to result in an outflow of resources. Not too much changed. Again, the definition of a resource has been refined in terms of an economic resource. It must be a present obligation. In section 2, the wording has been, again, improved, simplified to state, in order to have a present obligation, the entity must have an obligation. The obligation must be to transfer effectively an economic resource being a right, and that obligation must arise as a result of past events. As you've noted, the recognition criteria has removed this concept or the need to assess probability. So there is no need to determine how probable something is to assess whether it meets the definition of an asset or a liability. The probability is something that flows into the measurement. So as we see with the recognition criteria, all that we need for an asset or a liability to be recognized is that it meets the definition of an asset or liability. We no longer need the requirements that it is probable that there will be an inflow and outflow. The cost must be measured reliably. That has been removed. Simply looking at, does it meet the definition of an asset or liability? Yes or no? If it does, the recognition criteria have been met, and then as the next step, we move on to measurement. Lastly, just making sure that we ensure that the information is relevant, that it is also providing a faithful representation. If we look at our next section, which is consolidated and separate financial statements, which specifically deals with when an entity is required to consolidate another entity or one of its underlying entities, specifically noting that consolidation obviously is something that arises when an investor controls an investee. So the principle of control, consolidation, sitting in the standard, as well as looking at the accounting policies or the method of consolidation that an entity needs to apply, the uniformity of accounting policies, dealing with intercompany transactions, etc. So let's just have a look at what has changed in the standard, noting that this is area 2 of 6 sections that has changed quite significantly in terms of principles, application, in terms of wording, etc. So in looking at the improvements that have been brought into Section 9 as a result of the amendments that we have seen in IFRS 10, the first thing that we will have a look at is the updated definition of control. We need to have, or an investor needs to have control in order to consolidate an investee. So we will just have a look at what is determined, what is defined as control, what are the criteria that needs to be present. That is one of the key areas that we will look at. And the second key area that we will have a look at is what happens if we have a subsidiary over which we had control. However, we have a partial recognition or a partial disposal of that investment so that we actually retain some form of an interest, whether that be in the form of an associate or purely in the form of an equity shareholding. What is the accounting treatment that needs to be applied in such an instance? Some further good news, the ISB has retained the rebuttable presumption that control does exist when an investor holds 50% or more of the majority or the voting rights of an investee. I think that is something that is quite useful in practice, specifically in relation to IFRS for SMEs. So that is a rebuttable presumption. It is assumed to be present. You would need to rebut it or disprove it to indicate, for instance, that there may be an instance where an investor holds less than the majority of the voting rights. However, based on the definition of control, that it does control the investee and therefore would need to consolidate. This principle of control and the single basis of consolidation, what it is trying to achieve is to ensure that there are instances absolutely where an investor does hold majority of the voting rights, however, does not have control, or in the instance of holding less than majority of the voting rights, but through contractual agreements or option contracts, actually is in a position to control the investee. I think this one is quite important to reiterate. We have in full IFRS the ability to apply a consolidation exemption, which relates specifically to investment entities, an investment entity being an entity which invests solely for returns of capital and appreciation or income or both on behalf of another party. Those entities generally would not fall within the scope of those users or preparers of the IFRS for SME standard based on the public accountability. So that was not considered for purposes of this third edition. And it is important to mention as a reminder that Section 9 does not allow an entity not to consolidate its financial statements if it is the ultimate parent. So the ultimate parent, still under Section 9, is required to prepare consolidated financial statements. It is only an intermediate parent that will not be required to prepare consolidated financial statements, provided the ultimate parent is preparing financial statements in accordance with IFRS for SMEs. If we have a look at the requirements for control and respectively the definition or the principle of control that has been brought into Section 9, control consists of 3 elements that need to be present in order for an investor to control an investee. Those 3 elements are as follows. Number 1, the investor needs to have power over the investee. We will unpack that a bit further to understand what is power. Secondly, the investor needs to have exposure to variable returns from its involvement in the investee. We'll have a look at what it means to have variable returns and what some examples of that are. And lastly, the investor, through its relationship in the investee or through the power that it has, must be able to affect, in other words, influence the returns of the investee and effectively the ones that the investor will ultimately obtain. So 3 elements then are present in an instance of control. Firstly, if we have a look at the principle of power, what is power and what do we need to look for in assessing whether an investor has power over an investee? And in respect of the 3 components, when we look at control, this is probably the most important one to assess and often the most difficult one to assess in practice. We have a look or determine power to be when an investor has existing rights that give it the current ability to direct the relevant activities. So there are 3 very important principles that we need to understand here. The first being relevant activities, the second being existing rights, and the last one being current ability. So all of these 3 things need to be understood and assessed in order to determine whether an investor has control over an investee. When we look at relevant activities to determine whether an investor is able to direct relevant activities, we understand relevant activities to be those activities that significantly affect the investee's returns. Those can be quite broad. Those can relate to specifically in terms of maintaining capital, obtaining capital or funding, how that is applied. It's looking at which assets to sell, which markets to invest in, which markets to operate in, which products potentially to undertake more research and development in. So relevant activities generally is quite broad, and it is the decisions or the activities that ultimately will impact the bottom line, the profit of the reporting entity or the investee. Secondly, we will have a look at existing rights and the need for existing rights to be present. The existing rights is the tool or the method that provides the investor with the ability to direct relevant activities. Those existing rights in its most simplest form would come through the voting rights attached to shares. They could also relate to contractual agreements where a party might be able to determine the relevant activities without actually holding 50% of the ordinary equity of that investee. But it also can be very much dependent on the facts and circumstances, specifically in larger group entities where you might have a related party that is holding majority of the shareholding of that entity, but that related party really is just a representative of the ultimate holding company or parent, and actually, therefore, the ultimate holding company or parent is the one that has de facto control on the basis that even though on the face of it, there is another entity that has the majority of the voting rights, they are actually just an agent for another party, usually a related party within that group structure. Understanding this code component regarding the current ability to direct the relevant activities, it is very, very important that we understand that an investor need only have the ability to direct the relevant activities. What does this mean? This means that an investor might be in a position to exercise specific rights, voting rights, options within a contract, which would allow them specifically to block any type of decisions should they not be happy with them. The important thing noting that those rights need to be substantive. So what we understand to be substantive means that those rights need to, number one, be practically exercisable in terms of a contract, so that they need to be currently exercisable. And secondly, they would need to be in the money. So when assessing control, it's not purely a matter of does the investor currently control the relevant activities? Are there specific agreements, contracts, potential voting rights in place that would allow them to step in at any point in time and override any specific decisions that were made in respect of relevant activities? So that is in respect of the first component, looking at power of the investee. What do we need? Noting relevant activities, existing rights, and current ability. As mentioned, that is probably in practice one of the areas that requires the most amount of attention and at times judgment. And looking at the second requirement in terms of assessing what needs to be present for an investor to have control, we need to make sure that the investor has exposure to variable returns. Noting exposures is not only positive, but also could be negative. And as a result of their exposure or their investment in the investor, they have this exposure to the variable returns. The variable returns relate to anything in relation to interest, dividends, any form of economies of scales, synergy, the very nature of the investment in the underlying investee would also be subject to an impairment assessment. So the variability generally is not such a big issue because the exposure comes through in multiple ways. Lastly, having a look at the requirement to link this first and second component that we saw present in control. So number one, there had to be power. Secondly, the investor was subject to variable returns in the investee. And thirdly, this element that the investor, through its power, through its rights that it has the ability to affect the returns, the variable returns that it holds in the investor. So simply just effectively knitting together that principle one and two, making sure that they are present, and number three, making sure that through its control, it is able to use its power to affect or influence those returns. So in terms of the changes in the Section 9, we just see this, we still see the rebuttable presumption present in terms of if you hold majority of the shareholding, it is presumed that you have control. There is, however, this control framework that has now been brought in, which is aligned to IFRS 10, in allowing a preparer to assess whether control is present based beyond the legal form of the agreement. So effectively looking more to the substance of the structures of the contractual arrangements. The second amendment or significant amendment in Section 9 specifically relates to the loss of control of a retained investment. When we look at the loss of control, we would previously have a subsidiary. We will have sold some of our interest in that entity, but we will have retained some of our shares. Those shares could be an investment in an associate, it could be a joint arrangement, it could be a shareholding purely in ordinary equity instruments. The standard requires a preparer to recognize any resulting gain or loss in profit or loss in respect of the sale. So maybe principally to understand this best, if an investor has an investment in an investee and they sell some of that shareholding, in other words, you had 100% and you are left with 10%, what the standard requires, obviously in terms of the existing consolidation principles, is a deconsolidation that needs to be applied. Once we have applied the deconsolidation, we need to recognize the retained interest. Say, for example, that is a 10% interest. That 10% interest must be measured on day one at fair value. That fair value possibly can be determined from the transaction price, what you receive in relation to the 90% that was sold. However, in addition to recognizing the retained interest at fair value, the reporting entity will need to recognize the difference in the retained interest and the selling price and the net asset value that was sold. Effectively, it results in a balancing figure in your journal entry. That difference in what was left and what was sold in relation to the fair value needs to be recognized in profit and loss. And in substance, that represents the principle that we see in full IFRS as well, in that the view is taken that the investor effectively sells the whole subsidiary and then recognizes a new investment at fair value. So it's easier to think about it that way, both in terms of a deconsolidation and in a step acquisition, which we will discuss a bit later, in that the accounting methodology that is applied is that the investment, whatever it is sold, and a new investment is recognized at fair value, and any gain or loss that is recognized or arises on this transaction must be recognized in profit and loss on the basis that this is the sale of an asset. Having a look at our third section, being financial instruments, as I mentioned, we now have one section for financial instruments. So previously we had section 11, which was basic financial instruments, and we had section 12, which is other financial instruments. Everything regarding financial instruments is now housed in section 11, and section 12, which previously was other financial instruments, now relates to something completely different, which is fair value measurement. So other than this shuffling of the sections and housing everything regarding financial instruments under one roof, some other things that we see or note is that section 11 no longer allows this fallback to IAS 39. So there is nothing in this third edition of the IFRS for SMEs accounting standard that falls back to another standard in the full IFRS for SME framework. Everything is in this third edition. There is no more IAS 39. However, in section 11, we will see that that has now been broken down into two parts. As mentioned, our fair value measurement is now our new section 12. A few things to keep in mind, as mentioned at the beginning of this presentation, some relief that was offered in terms of the third edition is that the incurred loss model is retained. So there is absolutely no changes in terms of how impairments are assessed, what an entity's accounting policy would be in terms of determining whether a financial asset is impaired and whether an allowance needs to be recognized. There have been no changes in the hedge accounting requirements, and there have been no changes in the derecognition requirement criteria. As mentioned, section 11 now consists of two parts, so we can certainly see some similarity from the second edition, except that even though we have this part 2, it sits in section 11. Part 1 deals with our basic financial instruments. Those would be things like cash, trade receivables, loans, whereas part 2 deals with our more complex instruments. Those would be things such as our derivatives. Those would be things like potentially our ordinary equity shares that are listed, convertible preference shares, and instruments that are generally by their nature more complex. So what are the 3 key changes that have been brought through in section 11? The first one is that the principle regarding the classification and measurement of financial instruments has been simplified and brought in from full IFRS. So understanding that the classification very much drives the measurement, we will address that in a bit more detail and understand what that means. There have been some additional disclosure requirements for financial assets and liabilities. We will unpack that a bit more. As I mentioned previously, the disclosure requirements is something that will be impacting every reporting entity. And then something interesting that has come through from full IFRS is the recognition and measurement of financial guarantee contracts. We will just have a look at understanding what is a financial guarantee contract, understanding what Section 11 requires, specifically Part 2, in respect of a financial guarantee contract in terms of the recognition and measurement. However, noting that the ISB did simplify the accounting for a financial guarantee contract, specifically in the instance of an intra-group. That is generally where we see these to be most prevalent, looking at what the accounting requirements are for financial guarantee contracts within a group setting. Just bearing in mind, financial guarantee contracts are something that we just sometimes need to be careful of, and that is something that would impact the accounting in the separate financial statements of reporting entities within a group structure. So just having a look at the first primary area of changes in Section 11, we see that the classification has been simplified, which aligns very much to our IFRS 9, which looks at the contractual cash flows of that debt instrument. So when looking at the contractual cash flows, we determine whether, or the nature of those contractual cash flows, and those cash flows, whether they meet certain requirements, will result in a financial asset being classified and subsequently measured at amortized cost. If you are familiar with full IFRS, in full IFRS, we do have this test that is also applied, which I will address now in a bit more detail, which is the test that relates to solely payments of principal and interest, or the SPPI test. We have that requirement, and we have a second requirement, which requires an entity to look at the business model for managing those assets. Just as an indicator, that requirement to look at the business model is not present in the IFRS for SME standard. So it is purely a matter of assessing the nature of the contractual cash flows. So what is the standard? What is the principle that the standard has brought in? The standard has said that if a financial asset meets the requirements of, or the way the contractual cash flows represents cash flows that represent solely payments of principal and interest, then that instrument will be classified as a debt instrument, as an SPPI debt instrument, or an amortized cost debt instrument, and will subsequently be measured at amortized cost. So you can see that the classification is deriving the measurement. Provided SPPI is met, we will classify and measure the instrument at amortized cost. What does it mean for the cash flows to represent payments of solely principals and interest? In very simple English, it really just means that the debt instrument should represent a basic lending arrangement. In other words, there is nothing funny sitting in these contractual cash flows. Something funny would probably be something aligned to some form of exposure to the underlying equity of that entity. It would be some additional returns over and above those representing interest. For example, sharing in respect of some form of a profit margin. So in simple English, just looking at this, does the nature of the instrument represent a basic lending arrangement? Is there anything else funny in there? If there is something else funny in there, it will not allow us to classify the debt instrument at amortized cost, and we will result in recognizing and measuring the instrument then at fair value. Some additional other changes that we have seen in respect of additional disclosure requirements specifically relates to, as I've mentioned, the classification and measurement basis, specifically as we've seen for debt instruments has changed. So we will see that this wording and this change in wording is going to flow through in the accounting policy information that reporting entities are providing in their financial statements. But over and above that, we've had some additional disclosure requirements have been brought into Section 11. which specifically relates to, as mentioned, the outreach and the feedback received from users of financial statements that have requested a better understanding of the liquidity of these entities. The disclosures that we see coming through, and as noted, will impact all reporting entities, specifically relates to providing an age analysis for trade receivables in respect of our debt instruments, and for our financial liabilities, a maturity analysis, which outlines the contractual cash flows and the specific timelines in respect of when we anticipate those contractual cash flows, so not being discounted cash flows. Lastly, as mentioned, the further amendment or significant amendment that we saw come through in section 11, which specifically now relates to part 2, or 2, noting that this deals with our more complex instruments, relates to financial guarantee contracts. The financial guarantee contract, specifically defined as a contract that requires the issuer to make a specified payment to reimburse the holder for a loss it incurs because the entity fails to make its payment of the instrument as and when due. Now, financial guarantee contracts fall into part 2, which means that the financial guarantee would need to be measured at fair value. However, noting this, the ISB obviously applies this simplification approach under the IFRS for SME standard in order to simplify the accounting, and noting that reporting entities that are applying the 3rd edition of the IFRS for SME standard probably would only be exposed to financial guarantees in the form of an intra-group setting, where you have one entity effectively guaranteeing the cash flows of another entity within that group, generally to a lender of that group. In the instance where we have these financial guarantees, and generally they are issued for no consideration between the entities within the group, so as a result, we might tend to miss them unless we ask the necessary questions. If there is a party or an entity within the group that is guaranteeing the cash flows of another entity, that entity will have a financial guarantee contract that will need to be assessed in terms of section 11. If it is intra-group and if it is for nil consideration, these financial guarantees will not be in the scope of section 2, part 2, which is good news. They move to, or they would be in the scope of section 1's provision and contingencies. In other words, they would only require recognition if there really is some form of a provision that needs to be met. However, even though the requirements for recognition are certainly more stringent under our section 21, there are additional disclosure requirements that are required. So even though the financial guarantee might be intra-group, we will need to make sure that the nature and the purpose of these contracts is disclosed, that there is an indication of the uncertainties relating to the amount of timing, and most important, coming back to this requirement, disclosure of the maximum that an entity would be required to pay if the guarantee is called on. So that in the separate financial statements, user of those financial statements would have an understanding or insight into the potential exposure the reporting entity has. Right, having a look at our 4th amendment, and the principles of fair value are not new to IFRS for SME reporters. Fair value is inherent within many sections within the standard. The requirement as to when to apply fair value or when you need to measure or determine fair value is housed in the relative sections. All that the section 12 now does is that it brings together all of the principles of fair value measurement and helps us in identifying how we measure the fair value, and very importantly, the disclosure requirements that are required in respect of fair value measurement. So what we see is that this section 12 has very, very much been aligned with IFRS 13 within our full IFRS accounting standards. And it specifically deals with the how to measure our fair values and specific additional disclosure requirements, again, which will impact all reporting entities, specifically with regards to the level in the fair value hierarchy that was used to determine the fair value, as well as the inputs that were applied. So in order to understand that, let's just quickly have a look at the definition of fair value. This definition has been aligned to that in full IFRS. Principally, there may be some nuanced changes, but what we understand fair value to be in the second edition and the third edition hasn't significantly changed, noting that is a price that we would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants. So very, very important, fair value is always an exit price, whatever we would receive to sell an asset. Noting that it is an orderly transaction, it is not a forced sale, and that this relates to market participants, specifically noting that it is not a transaction between related parties and that it is not an entity-specific value. Right, when determining fair value in respect of an asset or liability as driven by other sections in the standard, an entity has three different approaches available in order to determine the fair value. Its easiest would probably be some form of a market approach, for example, a listed share. It would be easy to determine the fair value of a listed share based on a traded price. An income approach, aligned very much to something like a discounted cash flow, where you are looking at future cash flows or income or expenses and discounting back to a present value. And the cost approach, which very much looks at a replacement cost approach in respect of a certain asset or liability. While there are certain techniques available, it is important that an entity uses the appropriate valuation technique given the nature of the asset or liability to make sure that we obviously attain or retain this principle of faithful presentation. And very importantly, an entity must always make sure that they maximize the use of observable inputs in order to ensure that the extent of subjectivity in that valuation is limited. So to the extent that one can use objective inputs, those should always be applied as a starting point. As a matter of interest, if an entity does change its valuation technique for whatever reason, moving from a market approach maybe to an income approach, if a market is no longer specifically liquid for a specific asset, that is something that is done prospectively. It does not change an accounting policy. It is simply an estimate that is applied. So it is not something that is done retrospectively. It is purely a method of determining or measuring an asset liability. So in order for us to understand the disclosure requirements, it is important that we understand that the fair value is determined by a technique, as I've mentioned on the previous slide. However, in order to determine the technique, we obviously have certain inputs that are placed into that technique. And depending on the extent of how observable the inputs are, that determines where we sit in what is referred to as the fair value hierarchy. So the fair value hierarchy consists of three levels. At its top level, we have effectively what would be the most objective means of determining fair value, determined based on quoted prices of identical assets, specifically noting that that has to be in an active market. This would be instances of any listed instruments on the JSE. If we looked at the share price, all of us would look up the share price and get the same answer. So very little judgment involved in determining the fair value of this instrument. However, if we look to level two now introduces some form of judgment that is applied, specifically relates to instruments that are not quoted, or if they are quoted, the market is not active. We sometimes see this with specific bonds where they are not appropriately traded or not traded with significant volume. Therefore, they shift into a level 2 instrument. Other examples would be our derivative instruments, our forward contracts, interest rate swaps, things like that. They do have an element of observability priced into that measurement method. Level 2, obviously noting, requires definitely some form of estimation or assumption applied. And then right at the bottom, level 3, the level that requires a significant amount of judgment. If you, for example, have to think of measuring the fair value of investment property, if all of us had to determine the fair value of a specific investment property, it is likely that we will have quite a range of different outcomes, given that that is subject to specific inputs that are unobservable. Why is this hierarchy so important in IFRS section 12? It is important because as the level of subjectivity increases, as we move further down into level 3, is it important for your users to understand what the inputs and the assumptions that were applied by the preparer to determine the fair value. So what we see coming through in section 12 in respect of the disclosure requirements is that a reporting entity, specifically with all of the instruments, first and foremost, has to disclose the valuation technique that is applied. So whether that be an income approach, a market approach, or any instrument for which you are using a fair value, you would need to disclose the technique as well as the inputs that are used to determine that technique. Inputs obviously would not be so relevant in respect of a level 1 where the price is observable, but certainly in level 2 and specifically in level 3, the inputs that are used to determine that fair value. There is a distinction made in terms of in the standard, specifically with regards to where fair value is determined on a non-reoccurring versus recurring basis. Specifically, where the fair value is determined on a recurring basis. And that fair value is determined in respect of level 3. There is an additional disclosure requirement for preparers to specifically indicate the gain or loss, in other words, the fair value movement that was recognized in that reporting period, and noting specifically where or which line item in profit or loss houses that fair value movement. So the accounting policies could address the geography of where that fair value gain or loss is recognized. However, this is specifically required now as a specific disclosure requirement in terms of IFRS 3. So I think we can see that principally not too much has changed in terms of fair value, but there will be additional disclosures that will be required in this third edition. Having a look at our business combinations and goodwill, section 19, which has been aligned to our IFRS 3 business combinations. In terms of understanding what the changes are here, the first one being understanding that the definition of a business has been aligned to IFRS 3. I'll have a look at that now. The definitions of an asset and liability, which we spoke about earlier, have been aligned to those in section 2, effectively referring to a right. It only needs to have the possibility of the benefit. There is also an additional indication of noting that we need to be careful of instances where we have a newly formed entity that is purely being formed for the purpose of acquiring another operational business. Those instances are generally referred to as what we refer to as reverse acquisitions. It's a very specific set of facts and circumstances that need to be present. For now, I would just ask you to be mindful that if there is an entity that is purely formed to issue equity to acquire an existing operating business and standalone reporting entity, that there is this matter of considering whether that is a reverse acquisition. And lastly, we will just talk about the recognition requirements in terms of contingent liabilities. There has just been some clarification in terms of the wording to understand in what instances do contingent liabilities need to be recognized on acquisition. So we'll have a look at those in a bit more detail. Maybe just keeping in mind that Section 19, business combinations and goodwill, is applied on acquisition. In other words, the principle of control needs to first be assessed when an investor inquires an investee and we have determined that control is present. Then we move to Section 19 to apply our business combination accounting, provided that we have acquired a business and not assets. When we are dealing with an asset acquisition, that is not within the scope of this standard. Right, so clearly just differentiating between assets and a business combination. Right, what has changed? One of the things that has changed is specifically regarding contingent consideration. Contingent consideration, specifically an instance where there is an additional payment that will be made by the investor at a later date. Contingent consideration is required to be measured at fair value. In terms of fair value, provided that can be determined without undue cost and effort. If not, we would have to apply a most likely amount, so some form of an estimate, and in subsequent periods, provided that that contingent consideration does represent a liability, if it is a fair value measurement, a fair value movement will be recognized in profit or loss. However, if we've applied a most likely amount measurement, then provided that contingent liability is a liability and does not relate to an equity instrument as determined by Section 2022, we will simply make sure that the adjustment or the movement in the most likely amount is also recognized in profit or loss. Alignment with IFRS 3, acquisition costs must always be expensed. Very clear on that. There is no option unless it specifically relates to the issuing of a debt or an equity instrument. But when we're looking at legal costs, due diligence costs, fees, they must all be expensed. And similar to the principle that I spoke about earlier, where we have a subsidiary and we lose control and we retain some form of investment, the same principle has been brought into Section 19, where we're looking at a step acquisition, so in other words, increasing our shareholding. If we initially had an investment, whether that's associate, joint arrangement, or looking at equity investment, where a reporting entity had an investment and subsequently now obtains control, for the purposes of how the standard applies the accounting, the easiest way to think about it is that the methodology is applied is that the original investment is sold. That investment will be sold for a fair value and will result in a gain or loss between the existing carrying amount and the fair value. And that gain or loss will be recognized in the income statement. So we can see that these principles very much mirror those that we saw previously regards to step acquisition, or should I say step deconsolidation, or where we are only retaining a specific interest in our shareholding. In terms of the acquisition method, not too much has changed there. There has been some refining again of wording. We need to identify the acquirer, noting to be careful of any instances of reverse acquisitions. The acquisition date is very much driven by control and assessing when we have control. Fourthly, making sure that the assets and liabilities, as we understand per the definition in Section 2, that all assets and liabilities are determined at fair value, noting that non-controlling interests still can only be measured at the proportionate share, so there is no option to fair value any non-controlling interests, and recognizing any resultant goodwill or gain on bargain purchase from the acquisition. So the methodology that we apply for an acquisition is no different. The only things that have changed is being mindful of reverse acquisitions, noting that in respect of contingent consideration, that needs to be measured at fair value, and also noting that specifically for our contingent consideration that needs to be remeasured, whether that is at fair value or at some form of an expected value. The definition of a business has been aligned to that of IFRS 10. I don't think that there will be a significant change in terms of the application or what we understand to be a business. Very much this relates to an integrated set of activities that are capable of producing an output. So very importantly, it need not be in a position to already or need not already produce output. It certainly, however, does require inputs and processes to be present. Just lastly, in terms of one of the other things, there is no change here in terms of intangible assets. These are only recognized on acquisition, provided that they meet the requirements in Section 18 and that the asset's fair value can be determined without undue cost or effort. So there have been no changes there. Obviously, if it cannot be determined without undue cost and effort, then an entity would not apply the fair value measurement. I did see a brief question come up. I will address most of them at the end, but while I did see that one coming up regarding the optional concentration test, some of you might know, is housed in full IFRS. That has not been brought into the standard, so there is no reference to this optional concentration test in order to assess whether we have a business or not. Right, coming to our last section, and yes, it is quite a big one, revenue from contracts with customers. Those of you that have dealt with the implementation of IFRS 15 will have noted that the method of determining how to measure and recognize revenue from contracts with customers can be quite a mind shift from what we are used to. And some entities may be impacted, some may not, and some may be impacted quite significantly. And that definitely depends on the nature of your operations, what you are selling. Specifically, if you are dealing with bundled transactions where a customer ultimately is receiving more than one thing at the same time or over a period of time, and there is one transaction price, there is one price that the customer is quoted or is aware of in respect of obtaining multiple things, and these multiple things that we refer to are promises. So what is this 5-step model that sits in IFRS 15 and that has in its entirety been brought into Section 23? Section 23 identifies the 5 criteria that need to be present. Number 1, we need to make sure that we have a contract with the customer. We will have a look at that briefly. I don't think that is too complicated and doesn't generally cause the biggest issues from an application perspective. Step number 2, which can be quite tricky, deals with the promises in the contract. So promises in the contract is everything that is promised to the customer. We will have a look at what promises are and understand what they are. Step number 3, determining the transaction price. That can sometimes also be a bit more difficult, specifically where we are dealing with things like discounts or any form of variability in the price. Number 4 is allocating the promises or the transaction price to the promises in the contract. So very much once we have this transaction price, allocating it to various promises if the customer is paying one price for multiple things. So already noting here, if this is something that as a preparer is present in your current operations, something that you definitely need to be mindful of. From an auditing perspective, being mindful of clients that are selling effectively what would be some form of a bundled transaction. And lastly, looking at the timing of the revenue recognition, which is based on a principle of over time or at a point in time. There are very specific criteria that are present to determine whether we recognize revenue over a period of time as opposed to a point in time. It is important to note that this framework applies to all contracts with customers in relation to revenue. So whether that be in a construction environment, whether that might be in terms of a service environment, whether it relates to sale of goods, Whatever the case may be, this framework deals with every type of revenue transaction in respect of a reporting entity. And therefore, there are these principles that might be more prevalent to certain entities or operations than to others. Just a quick reminder which transactions are in the scope of 23. Just noting that section 23, or this revenue section, is a residual section, which means that we look to other places first to see whether there are other sections that require you to apply that section to that transaction. These are generally quite specific, like financial instruments, leases, insurance contracts, etc. So what needs to be present when we want to account for a transaction as a revenue from contracts with customers? Firstly, we need to assess whether step 1 is met. This is generally just an assessment of whether we have an agreement between two parties, whether the agreement has commercial substance, that we know what the rights and obligations of each of the parties are, that they have approved and committed to the terms of the agreement, and that there is definitely some form of probability associated to the collection of the payment. So whether this agreement is tacit or in writing, in practice, I think some of the biggest ones to look out for is to make sure that the transaction contains commercial substance and that the probability of collection of payment is present. If it is not present, it does cause some problems in terms of meeting the step 1. If you are not in step 1, you would not be able to apply section 23, which means that you would need to now go to section 10 to look at forming some form of an accounting policy regarding the sales or the revenue in respect of which collectability is not probable. Step 2 is definitely one that we would need to apply a lot of attention. And if this is something that is relevant to your operations, specifically dealing with bundle transactions, in respect of the 3rd edition of the standard, this is definitely where I think that you should start focusing your efforts. Step 2 requires an entity to identify the promises in the contract. Maybe just some clarification if you are familiar with full IFRS. Full IFRS refers to performance obligations. That term is not present in IFRS for SMEs. We simply refer to promises, again, in line with the principle in order to simplify the accounting. So what is a promise? A promise is an obligation to transfer, very importantly, a good or service that is distinct, or it could be a series of distinct goods or services. So where you have a repetitive service that is offered, maybe to make it a bit easier, you would look at something like a gym contract, where every month, in terms of your gym membership, every month would be a series of an identical service that is being offered to you. Pattern of transfer is the same, so the customer would benefit, would have rights to access that gym on a daily basis throughout that month. Pattern of transfer and the benefits to the customer would be the same from month to month. So in order to determine whether a good or service is distinct, there are 2 requirements that must be present. Very importantly, this is an AND test. Specifically, the customer must benefit from the goods or services on its own, or together with other readily available resources. And the promise to transfer the goods or services must be separately identifiable in the context of the contract. These sometimes can be quite tricky to apply in practice. The important thing is to identify, in terms of the promises in the contract, are they distinct? Because if they are distinct, they will require separate allocation of the transaction price. So in terms of the definition, if they are distinct, in terms of step 2, step 4 is going to require separate allocation of the transaction price to each of these promises. Step 3, which looks at the transaction price, is noted as the price or the consideration to which an entity expects to be entitled in exchange for transferring promised goods or services. Certain things that we need to be mindful of, specifically when we look at expectation, is any form of variability. If we are selling specific goods that have a right to return, where an entity has the right to return that product, in instances like that, we would have to recognize some form of a refund liability. So we can see in terms of the step 3, determining the transaction price, I think step 2 and step 3 definitely require very, very careful consideration to assess whether we are only recognizing revenue at the value or the amount at which an entity expects to be entitled. For purposes of clarity, just noting that we still have this ability to not consider any significant financing components where the payment terms are not deferred beyond 12 months. When we look at step 4, we deal with the allocation of the transaction, as mentioned, to the promises in the contract. There are certain simplifications available. I do think that they are relatively straightforward. There is no need to allocate a transaction price where the timing of when the control passes, when that revenue is earned, is in the same reporting period. There's no need to overcomplicate the accounting because it's not going to result in anything different, even if you allocated the transaction price to the promises. And noting that there are various methods that are available to determine how you would go and allocate the transaction price, specifically when you are dealing with bundle transactions. If you are a reporting entity that deals with bundling transactions, there are various methods that need to be applied to determine how the one price that you have set for the sale of that bundle needs to be allocated to the underlying goods or services that are promised within the contract. Lastly, having a look at the timing of the revenue recognition, we note that revenue will either be recognized at a point in time or over time. Timing of the revenue recognition, generally in terms of the way that the standard is written, is that we would assess whether it can be, whether it meets the requirements to be recognized over time first. And if it doesn't meet the requirements, then we would recognize it at a point in time. Very much based on the principle of control. So when does the customer obtain control of those goods or services? So we can see this inherent control framework present. In the interest of time, I'm not going to go into too much detail, but noting that in respect of the over time requirements, there are 3 methods or criteria that are available to assess whether control passes over time, with some examples that have been provided, noting as previously that Section 23 applies both to instances of construction and an entity purely selling one good or one service. So it might appear rather complex, but it is an example of, or an instance where we have control passing over time. And that's generally an instance where the customer is consuming the asset and obtaining the benefits as the entity is performing. Point in time, there are some indicators that we would look at in point in time, very, I think, straightforward, just, and I think very much quite objective in terms of if legal title is passing, if physical possession is passing, if there is a significant change in or shifting of the risks and rewards of ownership, if the customer has accepted the assets, etc. However, noting the way that the standard is written, generally we'd look at the principles of overtime, and if they are not present, reaffirming that they are point in time based on the criteria that we can see listed here. There is a lot of application guidance that is sitting in this standard, which helps in various other principles that I have not addressed today, specifically looking at things like modifications, warranties. Many of us, I think, will be relieved to see that the principle or the criteria, the principle of a principal and agent assessment is now housed in Section 23. So one would no longer need to refer to full IFRS. If you are a reporting entity that has customer loyalty programs, there definitely would be implications to Section 23. in terms of your revenue recognition and measurement. There are additional disclosure requirements, but I think as preparers of financial statements and even as auditors, revenue, without doubt, is the area that has brought in the most significant changes. Certainly in the way that we think about revenue, they may not result in changes in terms of recognition and measurement. That depends on the underlying businesses and the facts and circumstances, but they do drive additional disclosure requirements. From a implementation perspective, there is quite a lot of supporting material that is made available by the ISB. I did see questions of where is the standard available. It is available on the ISB's website under the IFRS for SME accounting standard. There is a lot of additional material which I think is very helpful. There is a basis of conclusion and there is an illustrative set of financial statements which is quite helpful. The ISB has issued some educational material, currently only limited to these 4. I find these educational material documents to be absolute gems. They are extremely detailed and they provide a lot of examples. Obviously, these are just the first few that have been brought in. I anticipate that revenue will be one that will be very, very helpful both to preparers and auditors. So do watch out for that additional educational material that will be made available. If you are struggling with any form of implementation, this would certainly be my first resort. Noting that there are, lastly, in terms of the transition requirements, as I mentioned, the standard is effective for December 2027. However, it is retrospective application that is required. There is some transitional relief available, specifically in some of the bigger standards, which is very helpful. Section 23 is one of the standards that does definitely provide transitional relief, and that it does not require a reported entity to go and back and reassess contracts that it entered into prior to its effective date to determine whether it would need to be accounted for differently in terms of Section 23. So simply, if you have a December year end, if you have revenue contracts that are completed prior to your effective date being 1 January 2027, you do not need to go back and reassess effectively all of your comparative accounting in terms of revenue recognition. I know I have gone a bit over. There was a lot to cover, and there is a lot in the standard. I'm definitely available to address any questions as we go through them. I thank you for your time. It is quite a lot to get your mind around. If you haven't had exposure to full IFRS, it might feel a bit lighter. The load might feel a bit lighter. But otherwise, please feel to reach out to us if you have any specific questions.
Yes, thank you everyone for joining us. Just a reminder about the next steps for those that are wondering about CPD and attendance, etc. There will be a post-event mailer that will be sent out to everyone that registered. If you didn't register and you some or other way got onto the school, you will also receive that same post-event mailer. It will have the slides, it will have a recording as well as a quiz. You would need to attempt that quiz. It's 5 questions, true or false, for you to get your specific individual attendance certificate. And then if you are feeling a little bit overwhelmed with the changes or the new updates to the standard, in the next 18 months, we will all be deep diving into the respective sections, training our staff members on the changes. So please get a hold of your engagement partner if you are a client. And for the trainees, the managers and the partners as PKF, we will be running continuous updates to educate everyone on the changes and how this transition is going to take place in practice. For those of you who have asked the question and you don't mind staying on, there's 2 questions I think that Claudia can address. But for those of you that need to run, thank you so much for joining this session. We do appreciate your time. Yeah, Claudia, there was 2 sessions, the quick questions. The one was about the insurance contract, and then there was a later one that dealt with, just go back to that one. Okay, where is that?
Was the
example
second
of?
one on the change in the asset definition?
It looks like the same one. Yeah.
Okay. I think so. The second question, if I recall correctly, the one that I saw related to how providing an example where the change in the asset definition would result in potentially different recognition or measurement. So the short answer is we don't often see any specific changes. It's just in terms of the recognition criteria, specifically look at whether we can recognize something. And then as the second step, in order to process any journal entry, we always then have to look at measurement, at what amount do we recognize this asset or liability. And the measurement, by its very nature, takes into consideration probability. So if I look at the asset definition on its own, previously in the prior asset definition, it had to be probable that there would be an inflow of economic benefits. So if it was not probable, then we would not, in terms of the definition, we would not even go to the measurement criteria because we would not meet that first step. So that would result in us not recognizing an asset. However, under the new definition, we don't look at whether that probability is present. We simply look at, should we be recognizing asset, specifically in terms of whether we have a right and it purely has the potential to produce an economic benefit. If it has the potential, yes, we meet the recognition criteria. We now move on to measurement, and measurement inherently is going to assess probability. So if you look at the components of that, you are most likely going to land up in the same boat in terms of the same accounting. It's just where we assess them in that kind of chain of events. The only time where it might be different is respect of that first step where you have a right and respect of that specific entity. Under the old definition, it was probable that there would not be any form of benefit to that entity. So then they would just stop there. They would not recognize anything. Under the new definition, even if there is not a probability, it just means from a measurement perspective, the value is going to pretty much be zero, minimal.
Yeah, I think also the idea is not, I think so. And I don't think the idea was that there should be different applications to the definition of an asset. It's just to actually bring it more in line with what IFRS also says. I've just reposted that initial question. It links with insurance income and if it could be regarded as an asset, to try and align the measurement or the mismatch when you need to de-recognize an asset that maybe was stolen and then you're waiting for that insurance payout to come. So I've just reposted that question for you in the chat.
Oh, okay. Sorry. I understood the context of the question initially incorrectly and I thought you were dealing with an insurance entity, which obviously would be out of the scope of the standard because it would not meet the requirements. Let's have a look at so insurance income. So that would be some form of compensation for stolen or lost asset, right? Can one raise an insurance asset under the new definition? So that would still, you would pretty much only be able to recognize any form of asset if you're waiting for a payout. If you're looking at things like our standard that deals with contingent assets and that, it would have to be quite certain that you are going to get some form of a payout. When an insurance claim is submitted, you would not be able to recognize an asset purely on submission. Companies' right to insurance proceeds. Yeah, so it definitely obviously needs to go through the process at an insurance company first. They need to obviously potentially send an assessor or whatever the requirements are in terms of the insurance contract, and only once you have some form of an approval in writing in terms of what the payout will be or that your claim has been approved, would you be able to recognize some form of a right effectively, because that's what it's going to come down to. Do you have a right that needs to be present in order to recognize an asset? Would this be recognized subject to the valuation that you spoke during your last answer?
The measurement, I think he's referring to the measurement element of that. We said the definition is almost like split into two.
Yes. So, well, first and foremost, there needs to be a right. And in my mind, the right does not arise purely because you have a contract. That obviously needs to be assessed in terms of the T's and C's of the contract. And once they make sure that you've done everything that you needed to, the right is established by the insurer approving your claim. Then you have obtained a right to some form of compensation. So that right needs to be present first, and I don't think the valuation would be so much of an issue as that would generally be in terms of the approved claim. They would indicate this is what they are proposing in terms of the payout. Are there any other questions?
Yeah. No. The last comment is just, so your right is not your assessment right, it is objective.
Yes. And that comes back to the principle of prudence underlying our accounting standards.
Awesome. I think that's that. Thanks, Claudia.
Pleasure.
Thanks, everyone. Those on the call.
Further.
Thank you. I'm going to end the meeting and stop all the recordings, etc. Thanks, everyone.
Thank you.